Hey everyone, and welcome to this explainer. Today, we're diving headfirst into one of the most dynamic, high-growth potential areas of the equity space, small cap stocks. When we talk about small caps, we're talking about the innovators, the disruptors, the companies that are rapidly scaling up. They're basically the growth engine of the broader economy. But, with all that immense growth potential comes some serious volatility. It's an incredibly exciting space, but it's definitely not for the faint of heart. Which brings us to a pretty massive challenge. When you have hundreds of these fast-moving, volatile companies reacting to literally every economic breeze, how do we actually track their performance? How does the financial world make sense of this specific market segment without just getting completely lost in the daily noise? Because you can't just throw darts at a board, pick a handful of stocks, and call it a day. We need a highly structured, reliable mechanism to capture the true heartbeat of the market.
Okay, let's dive into this. The ultimate solution, the compass that actually guides investors through the small cap landscape in India, is the Nifty Smallcap 100 Index. You've likely seen this name flashing across financial news or your trading apps, but today we're popping the hood. We aren't just going to look at what this index is. We're going to uncover exactly how it's built, how it's maintained, and why it is the absolute definitive benchmark for this part of the market.
Here's our game plan for today's explainer. First, we'll meet the Small Cap 100. Second, we'll go over the rules of the club. Third, we'll break down the math behind it. Fourth, we'll look at the sectors and top stocks. And finally, using the index. Let's get right to it. Part 1, meet the Small Cap 100, the exclusive club. So try to think of the Nifty Small Cap 100 not as a random bucket of companies, but as an incredibly exclusive, structured club. The whole point of this highly curated ecosystem is to accurately reflect the behavior and the overall performance of the small cap segment. To pull this off, it's strictly limited to exactly 100 tradable stocks listed on the National Stock Exchange, or NSE. It's a carefully chosen sample size, right? It's large enough to give us a real comprehensive market view, but small enough to represent just the top tier within that small cap universe. But how do you actually score one of those 100 coveted spots? Part 2, rules of the club and the eligibility bouncer. If the Nifty Small Cap 100 is an exclusive venue, these eligibility criteria act like a really strict bouncer at the door, making sure only the absolute most qualified companies get in. The inclusion steps are super specific. First off, any company already in the even more concentrated Nifty Small Cap 50 index gets automatic entry. They're already vetted. For the rest of the open spots, the bouncer looks closely at liquidity and size. A stock gets included if its rank based on average daily turnover is in the top 70. But, and this is a big but, they also must be selected from the top 150 companies based on full market cap within the broader Small Cap 250 index. It's basically two-factor authentication. You gotta be big enough, and you gotta be actively traded enough. But listen, just like any VIP list, you can get kicked out if you stop performing. Once you're in, there's a little bit of a buffer, but it definitely has hard limits. A company will be formally booted if its rank, based on full market cap, drops below 180 within the Small Cap 250. Also, even if they maintain their size, if their average daily turnover, meaning their liquidity, tanks and falls below rank 130, they're out. This is absolutely crucial because it ensures the index never gets weighed down by companies that investors can't easily buy or sell. Part 3, the math behind it, calculating the score. Okay, so now that we know who gets in and who gets kicked out, how does the club actually keep score every day? So the crucial point is that the Nifty Small Cap 100 uses something called the free float market capitalization method. This is a game changer. The index doesn't just look at the total overall value of a company. It specifically calculates value based only on the shares that are readily available for public trading, the free float. It totally ignores locked-in shares held by promoters or the government. Because of this, the index accurately reflects what you and I, the public investors, are actually experiencing out there in the open market. And to measure this performance over time, you obviously need a starting line. For the Nifty Small Cap 100, that historical anchor point, which they call the base date, is January 1st, 2004. Everything is measured relative to that specific day. And on that base date, the initial score, the base value, was set at a clean 1,000. So when you pull up the index level today, whether it's at 10,000, 15,000, whatever, you are directly comparing the free float market value of today's 100 companies against that baseline score of 1,000 from way back in early 2004. And this brilliantly illustrates the ongoing maintenance required to keep that score accurate. The market doesn't sit still, so neither does the index.
it operates on this really strict semi-annual rhythm. The review happens twice a year, using data cutoffs on January 31st and July 31st. They look back at the previous 6 months of data to see who actually met those bouncer rules we talked about earlier. And to keep everything transparent, they give the market a full 4-week notice before making any official swaps to the 100 constituents.
Part 4. Sectors and top stocks, the true VIPs on the list.
So, we have the rules and we have the math. What does this highly structured machine actually output? Who are the current VIPs? Now, what's really interesting about this breakdown is that when most people think of small caps, they picture, niche tech startups or specialized manufacturing. But look at this. Financial services commands nearly 32% of the total index weight. It's an absolute heavyweight. After that, we've got healthcare at 13.23%, capital goods at just over 8.5%, with autos and chemicals close behind. Looking at this gives you a crystal clear lens into where the real capital is flowing in India's small cap economy.
But when we zoom in from the broad sectors down to the specific companies, it's a totally different story. Look at the top individual constituents here. Naveen Fluorine International leads the pack at 2.50%, followed super closely by Career Visa Bank at 2.47%. Just think about that for a second. Even the absolute biggest players in this entire index max out around 2.5% of the pie. It's a brilliant structural safety mechanism. It gives you a highly diversified portfolio, so even if the top company has an absolutely terrible week, it's not going to single-handedly sink the entire index.
Finally, Part 5. Using the index and why it actually matters. Breaking down the VIPs and the math is fascinating, but how does the financial industry actually use this blueprint in the real world? Well, it matters because this index is a fundamental building block for modern investing. It's heavily used for benchmarking fund portfolios. If a mutual fund manager claims they're a genius at picking Indian small caps, their performance gets graded directly against this Nifty Smallcap 100 baseline. On top of that, it serves as the exact blueprint for launching passive index funds, creating ETFs, and structuring complex financial products. So it's not just some theoretical list, it's a real-world tool holding billions of rupees accountable.
So, we've seen the bouncer at the door, the math keeping the score, and the dominant sectors leading the charge. Which leaves us with this final thought. Does your personal idea of dynamic and chaotic small-cap stocks actually align with the incredibly strict, heavily structured reality of the Nifty Smallcap 100? Next time you hear about how volatile the small-cap market is, remember the rigorous blueprint quietly keeping order behind the scenes. Thanks so much for joining me on this explainer, and keep questioning the data.